thing that you need to remember, that regarding step 2, you have 2 things to remember. Thing number 1, what is a separate performance obligation and what is not a separate performance obligation. Now regarding separate performance obligation, the first thing that I remember is capable of being separate. Second, from the contract, is it different? So that's the first one. That's the general model. Capable of, actually is. Now, what is the other thing that I remember regarding performance obligations? The other thing is that basically everything is a separate performance obligation. However, there are exceptions. Which are the exceptions that you need to remember? Exception number 1 is the warranty. And exception number 2 is going to be the right to return. Why? Aren't they separate performance obligations? Well, if you look it closely, they are. But the standard is giving you specific rules how to deal with them, and therefore they are treated according to specific rules. All right? Transaction price. Now, this step was never ever identified during the old standard, how to determine the transaction price, because everybody thought that this is obvious. Let's see what is a transaction price. Transaction price is the amount of consideration which an entity, hold on, expects to be entitled in exchange for transferring promised goods or services separately to a customer. Entity expects to be entitled. So, once again, the transaction price, so the amount that you are recognizing as a revenue, left the so-called virtually certain criteria. It doesn't have to be virtually certain, therefore, variable consideration may be included. This is one of the biggest changes. It's the word expects. It doesn't have to be actually received or actually promised. Okay? Now, I told you that is a mean standard. Small little changes. That's one of the small little changes which will have a huge impact. Okay? Now, the transaction price would reflect the following. Consideration paid or payable to the customer. Hold on. The customer should pay me. No? Yeah, but in some cases, there are amounts payable to the customer. How can it happen? How can it happen? For instance, if I am giving them the bonuses, right? Sometimes I pay them bonus payments. What is a bonus payments? If they order a lot of things from me, I may promise them that I will pay them some amounts. Or non-cash consideration. What is non-cash consideration? Actually, I'm not getting money, but I'm getting what? I'm getting an asset instead. Actually, the rule is going to be very easy. Non-cash considerations are going to be acknowledged at a fair value. What do I mean by a fair value? If I'm getting the building, instead of getting money, how much is going to be the value of the building received? It's going to be the building's fair value. Basically, I'm treating it as if it was sold to me. Okay? Significant financing component. Thanks God we have here the word significant, because otherwise it would be a mess. Now, significant means that I am going to deal with the financing component if and only if the time value, the effect of the time value of the money is really significant. Okay? And also the variable consideration, which means that variable considerations are not deferred until the end, but we are going to include it unless there is an obvious constraint. Okay? And this is going to be the key word over here, the obvious constraint. Okay? So what do we mean by that? Remember it because you are going to use it a lot. Paragraph 56. That's going to be when you are not going to be allowed to recognize a variable. Right? That is going to be when you are not going to be allowed to recognize a variable. Now, let's see what do we have in the new standard, and let's see what is the change from the current IFRS. Once again, I summarized it in such a way That is my own opinion, so maybe it's not a full list. In the new standard, the transaction price is the amount, the consideration that the entity expects to be entitled. So that's the first thing. Yeah? The transaction price will include all of these, which were not explicitly stated with the previous one. So what is the change? Now, in the previous standard, the revenue was the fair value of the amount promised. So that was the so-called measurement objective, the fair value. Currently, entities may defer measurement of variable consideration until uncertainty is removed, typically when payment is received. Entities will need to estimate variable considerations earlier, so that means revenue will come sooner. Okay? Revenue will come sooner. That is the main effect of the new revenue recognition standard regarding the transaction price. Now, if you take a look at the variable transactions, I just covered accidentally with the table the words. But the transaction price may vary because of variable consideration. Definition of variable consideration is very wide. Identification of the variable consideration, therefore, is going to be a very, very important job. Look, these are the typical variable ones. Bonuses, refunds, returns, volume rebates, incentive payments. Hold on, I'm stopping here for a second. What is a typical incentive payment? When you do the job faster or in a better quality, you will get an extra cash. Okay? Multi-base fees, money-back guarantees. What is that? If you don't like what I'm doing, I'm going to give my money back. Okay, I'm going to give you money back. Hold on. What does this mean? This means that revenue, the variable part can be also negative. Okay? Can also be negative. Alright? Service level agreements. Alright? So you know that if I produce you a lot more than originally thought, you have to give me a discount. Penalties, discounts, price concessions, and liquidating damages. So these are the examples I think I can come up with. Alright? But obviously everything which is in the contract may be considered as being a variable consideration. Okay. Now how are we going to calculate the variable consideration? Why am I asking that? I'm asking that because that is the key question, how to include it. There are two possibilities. One of them is the so-called expected value, and the other one is going to be the so-called most likely amount. This is what we were talking about a few minutes earlier. So variable consideration is included based on using one of these rules, the expected one, which is, what is that? Which is the most likely outcome, the expected one, and the most likely outcome is the other one. When can I use the expected value? It's appropriate estimate if an entity has a large number of contracts with the similar characteristics. Okay? So this is the important part. You have to have a lot of contracts at the same time, and you enter into them routinely, right? Then you can use this. Like previously when I was telling you that the selling, how did I calculate it, how much did I get back? How much do I receive back from returns? I had a lot of transactions, I used weighted average. Now the other one is going to be the most likely outcome. The single most likely amount is going to be used as the value, and it is usually used when there are a few possible outcomes. Now, let's see how am I going to be able to deal with this. Indicators that suggest including the variable consideration in the transaction price could result in a significant revenue include. So this is the significant reversal situation. Otherwise, we call them constraints. If any of these are true, then I am not going to be allowed to include the variable consideration in the price. Let's see what are the possibilities. Consideration is highly susceptible to is highly interrelated to factors outside an entity's influence. Typical situation. Market volatility, weather conditions. So for instance, if you have a bonus for finishing the building early, what we had in the previous example, can you say that you are going to be able to do that? Of course, if weather permits, right? Are you going to be able to control that? No. Is it a constraint? Yes. Do you include the variable part in connection with that? No. Okay? So that's the first one, if it is outside of your influence. Uncertainty of variable amounts is not expected to be resolved for a long period of time. Okay? And I think this is the most usable one. If there is reasonable uncertainty, which is never going to be resolved in the near future, then we are going to treat that as a constraint and not going to include the variable consideration. Entities experienced with a similar contract is limited or has a little predictive value, which means that you may only include the variable part of the consideration into your price if you have a reasonable experience, reasonable past experience, which means that if you are just guessing, you have to wait. An entity has a practice of offering price concessions or changing payment terms and conditions. Okay, what does this mean? If you have a past experience with continuously keep changing the amount that you are asking for something, so you keep giving discounts continuously, then again, that is something when you have to wait until the variable until it's actually going to happen.
Now see, this is a quick one. Is there any change for, let's say for example, if a company is giving prompt payment discount, you sold it and then you give a 2% discount when
for what?
For prompt payment.
Prompt payment. Okay. Prompt payments, this is not in IFRS 15 to be honest. Prompt payment is not going to be a real price discount. It is what? It's financing. So you are going to include it into where, that discount? Financing expense if you give it, or financing income if you receive it. Right? So it has nothing to do with that part. Okay, that's not going to be considered as a variable consideration.
Because I'm just thinking from a transaction price perspective.
The transaction price is actually, you remember previously in the fair value part, we did that, but if you have that prompt one, which you get immediately, that's very simple. It's an easy fix. Yeah. It's finance income, finance expense, whichever is appropriate, whichever side you are at. Now let's see this example, and then we are going to see some more, and then we are going to make a short break. Well, not short actually. Entity enters into a contract will receive $100,000 performance bonus if specified performance targets are met. Try not to read it further and try to guess what is the solution, okay? Because I have all the solutions over there, which is not a good idea. Entity estimates 80% of the likelihood it will receive the entire performance bonus and 20% likelihood it will receive none of the bonus. Now what are you going to do with that? How many outcomes are there? And how many transactions are we talking about? One. This is what we call a binary nature, right? Which one are you going to take?
Most likely.
The most likely. What is the most likely?
80%.
How much are you going to include?
80%. 100,000.
Right? Everybody is like, I have to include 80,000. I know. Now, the one most likely outcome. And it's the same with provision. If there is only a few possible outcomes, which one are you taking? The most likely, right? Here, what is the most likely? The 100,000. When was that? The 100 is the most likely.
Yes.
So which one are you choosing? The 100. You are not allowed to use weighted average. In order to use weighted average, what do you need to prove? You need to prove that you have a lot of transactions behind it. Okay, now let's go to the next one. Okay, that one is, okay. Now you're not going to like this. An entity enters into a contract which will receive a performance bonus up to 100,000 if it meets specified performance target. Hold on, here you had only one possibility. Either you get the 100,000 or you don't. That was only one possibility. But here, it's up to 100,000. What's the difference? The previous one, either you get it or not. But here we have a lot of, not transactions, but probabilities. If it meets specified performance, not just targets, it estimates the likelihood of achieving the targets as follows. And you see here what they said. Now, what is the expected value of it?
60,000.
No, it's actually 59. And look, to be honest, the probability of getting, what is more likely? To get at least 60,000. How did I arrive to this? Because we are traveling from here to here, right? This is the outcomes which are more and more favorable for me. When do I reach the more likely and not situation? Right? Out of these three. So, according to the expected value approach, the best estimate might be 59,000 using this method. However, if you use the most likely outcome, what are you going to get? 60,000. So which one am I supposed to use? Now in this case, if I have several components, so it's not binary in nature, so not that I will get it or not get it, you are allowed to use either of the methods. So the 59 may also be used, however, the 60 is also an acceptable approach. Then how do I decide? Depending on my accounting policy. Depending on my accounting policy. I tell you what is the usual accounting policy. Let me show you another example. It's only slightly different. Look over here. Now if you use this amount, you will get 61. I just changed a little bit these. See? Just a little bit. Changed. If you calculate the weighted average, you will get 61. Why am I saying it's 60? Because it's about the most likely outcome. So most probably, the typical approach will be that you take, if this is the situation that you have one transaction, but not binary outcome, but multiple possible outcomes, that you calculate the weighted average, you calculate the most likely outcome, and you take which one? Whichever is the lower. Right? Why? Because this is actually not going to lead to any significant reversal later. Right? Because either one you are taking, both of them are going to grant you at least this amount. Okay? This is not clear yet. How are we going to deal with it in the future? But actually, Ernst & Young's view is this, that you have to take the smaller one, right? Because that is actually going to be a constraint, the most likely of the 60,000. Now, all right. Let's go and let's see this one. Other respect. Now, consideration paid or payable to the customer. Whenever we have consideration paid or payable to the customer, we have to consider two things. Thing number one, reduction of the transaction price and the revenue, or payment for distinct goods or services. What is the difference between the two? If actually it's a reduction in the transaction price, then I will deduct it from there. from the revenue, but actually if I'm paying to the customer because at the same time they are actually providing a service for me, what am I going to do? I'm going to put it to the expenses, right? So when is it a revenue reduction and when is it an expense? A revenue reduction if actually it is going to be a real reduction, and when is it going to be an expense if I'm actually giving a service. Okay. Non-cash considerations, the main idea behind it is to treat it at fair value. Okay, I already told you, so whatever I'm getting, I will include the fair value element of it. And significant financing component. What does it mean? Usually I sell items for 30 days, but I let you, and I sell it for 10, but I let you to pay not in 30 days, but in half a year. But in exchange, I'm asking you to pay me 12. What is going to happen with the 2 extra? Is it, what is that? It's a financing component, and financing, because of the late payment. I made you pay that much. What are you going to do with the financing component? You are going to treat it as finance income, or on the other side, it's going to be finance expense. Is it changing from the previous rules? No, it's not. So it's going to be exactly the same. All right. Good. Let's see this one then. Entity enters into a contract with the customer for the exclusive supply of paint for a 3-year period. Entity makes a $50,000 upfront payment, which the customer will use to customize its paint sprayers for the entity's product. Entity determines that the upfront payment is not a distinct good or service. So then the $50,000 to be accounted for a reduction of the transaction price. Okay? Now the entity estimates $1 million in sales with the customer over the 3-year period. The upfront payment is capitalized and amortized as the reduction of the revenue in proportion of the estimated sales over the contract term. So that's a typical example on what? Whenever you get an upfront payment, right? And how are you going to deal with this at the beginning? The calculation is over there. Now, time value of the money, I don't want to enter into it in details, but I want to enter into details on this, the sale incentive. This is the last one before today. Okay? Let's try to go through this one. Now, if I pay amounts to my customer, it can represent 2 things. Either a discount or a payment for a distinct good or service. If I make a payment for a distinct good or service, I will capitalize the amount and I will deal with it as if I was purchasing something. But if it's a discount, then it's going to be a reduction in the revenue. Now let's see how are we going to deal with that. That is the example. SPO Corporation, a beverage company, sells sports drinks to GRO, a grocer. SPO and GRO agree to a 1-year purchase agreement under which SPO will sell the sport drinks to GRO at $10 per 12-pack case, with the volume discounts available to GRO if it purchases certain minimum quantities from SPO as follows. Look, if they purchase less than 1,000 cases, no discounts. If they purchase more than 1,000 cases, then 10% discount. If they purchase above 2,000, then they will receive 20% discount. And if it is going to be over 3,000, then they will receive 30% discount. Now let's see what is going to happen. Previously, with this, we did not know what to do. Right? In the previous IAS 18 standard, there was no explicit guidance how to deal with that. But this one, what you see behind me, is very, very common. How do we call this situation? This is called a rebate, a volume rebate, basically, or bonus, whatever you like. Now, since this is a situation when the contract have multiple outcomes, And actually it involves a transaction which is really customary, since if you are a grocer or if you are a provider of this, you are going to have a lot of these transactions. Yes? Can I do weighted average? Yes, because that's something what I have a lot of examples of. So I am doing the following probability estimation. 50% probability that they will purchase less than 1,000 cases, 25% probability that they will have 1,000 cases, 15% probability of the 2,000 cases, and 10% probability that they will purchase 3,000 cases. So, at the end of the day, what we are going to do, we are going to calculate how much is the discount. Once again, it's not binary in nature, right? The outcome is backed up by lots of transactions. I'm not just selling to GRO, but I'm selling to several people, right? So I can use the weighted average approach. Now let's see how much is that. 0.5 times nothing, 0.25 times 10%. You understand the idea. So at the end of the day, I will get to 8.5% as a discount. Okay? Weighted average discount. This is what I think. So what I will do, that after the 6 months in the agreement, they purchased 500 cases. So what I will do, I will record only the 4,575. How did I come up with this? I sold 500. It was 10% per case. So this is the amount that they transferred. Right? So that is debit cash. Can I record all of them as revenue? No, because maybe they are going to purchase more, and then what is going to happen? The revenue is going to be significantly reversed. Therefore, I'm not allowed to do that. I will do what? I will only record what I expect to keep, and all the rest is going to be a liability. Now hold on for a second. The mechanics of this, is it complicated or easy? The mechanics is easy. What is hard? How to estimate this. And this is very common, these type of agreements. So what I need to do, I need to be able to say, how am I going to calculate that? Hold on. Can I say that I am not able to calculate it, therefore I simply say, I'm constrained from calculating, so I just ignore it. Can I do that?
Yeah.
In the variable. I told you that I can do it with the variable, that I'm ignoring it. Only if it's positive. In this case, it's going to be negative. Obviously, you can't ignore it. You understand what's the problem here? So if the variable is positive, ignoring it is prudent. But in this case, it's not going to be prudent. So what are you going to do? You have to try your best, right? Okay, you have to try your best. Because if you say that you ignore, you will record more revenue when? In the beginning, and it will significantly reverse. Understand? Okay.
Lassie, will it change if the discounts is in terms of the product itself? Like, so for example, you buy 100 cases, I give you 1 case free.
Of course,
so,
because your cost of sales is going to be going up, but the revenue for that part is going to be 0. So it's the same if you give them extra products.
So you value it at your transaction price?
Well, no. What you are going to do is you are going to say that if you are giving an extra product, you need to estimate how much is going to be the selling price of each. Because instead of selling 1,000, you are going to sell 1,003.5. You understand what I'm saying? You have to calculate with the free part. Got it? Guys, you should be panicking right now. Because that is actually bringing forward all the problems. Right? Now, without telling any names, I'm working a lot together with a grocery store. That's pretty big in Hungary. It's without telling. Well, you guys don't have it here, Tesco. You have Carrefour, right?
We have Carrefour.
Okay. Now, in that case, when they were trying to start the estimation, actually, currently, they are sitting on the floor and they do this. And the reason for that, because they have how many types of products? What do you think? More than 100,000 items. And for each and every one of them, they have these type of bonus agreements. Now, hold on.